Hi, this is Brian Bortz, one of the partners here at Kane Waters, and this is your investment update for the month of July. As always, I'm joined by Brad Sanders, the managing director of Tectonic, and there'll be a noticeable absence this month as Hunter Satterfield is out of the office serving our clients. But wanted to walk you guys through the month of July, which was an interesting month. The S&P was up 3.2%. The global stocks were up 3.8%, which both of those are a pretty big move for 1 month. Domestic bonds were basically flat. They were down 0.01%, and global bonds were up 0.7%. So I wanted to throw it over to Brad as we get started, just to talk a little bit about what is going on in the economy and how the Fed is handling this. Originally, we thought that the Fed was going to kind of hit a long pause, and then they changed their mind. So Brad, tell us exactly kind of what's going on up there.
Yeah, I guess starting with the Fed, the Fed raised a quarter point in July, and I think we weren't alone in our thoughts that they were going to go on an extended pause. But I think what's throwing them for a loop is that inflation's headed the right way, but it still remains higher than they would like. And employment is really low, and that's one of their dual mandates. And I wrote in our notes to our planners that I think the risks of a Fed policy mistake have risen markedly over the last few weeks. I think they may be staring at those unemployment numbers and thinking those need to go higher to really squash down inflation. They must have a worry that if they paused and with employment where it is, that once they were to back off of rates, that inflation would just spike again. That's really the only reasonable explanation why they're doing what they're doing. And so, we're really watching that closely. The economy, the liquidity in the economy is getting really tight, or the markets, I should say. And that's really usually a sign that things are going to start to get pretty volatile. And, the market doesn't seem to care on the flip side. As you mentioned, it was a good month. There's some good things going on in the market. Small caps were up 6+% in July, which is a huge move. And that's an area we've been focusing on and adding capital to. So I think the only those 7 stocks being the ones going up has started to change. The equal weight index is now much higher than it was earlier in the year. But this market's really expensive on the top end, and it's a very crowded trade. And the parallels to the dot-com period of 2000-2001 are almost getting downright scary. It went from the market being structurally the same, which I've been talking about for years, where you have one group of stocks basically driving all the return and all the money herding into that same group, to now even the narrative shifting. I can remember very vividly as a 19 or 20-year-old hearing in June of 2001 that was it, boys. That 50% drawdown was the one, and this is the new bull market, and this is your last chance to ever get in, and it lasted 3 or 4 months, and then everybody knows the rest of that. And it's the same thing now. I just hear that this is a new bull market and a new growth cycle being decried from the mountaintops. And I just, in my 25 years of doing this, I've never seen so many people ignore simple facts. And I think the main one is that rates a year ago, or a little, 18 months ago, were 0, and now they're headed to 6. And there's no way that the world operates the same, and valuations stay the same and just continue to bloat when you go from a 0% world to a 6% world, unless the laws of finance just magically don't matter anymore, which I refuse to believe. So I think this is a market we should all enjoy. It being up double digits this year is great. You shouldn't argue with it. You have to stay engaged in the market, but you want to do so with your eyes wide open, because I think the back half of the year, if the back half of the year is as good as the first half of this year, I'll be very, very pleasantly surprised. Let's just put it that way.
Thanks, Brad. I appreciate that. And one of the things that I talk to our clients about all the time is that we still expect continued volatility. But we are seeing that shift that Brad just mentioned, where we're having more of a broadening of the market. Small cap companies are coming back nicely. Value companies are coming back nicely relative to growth. And so a lot of those different areas of the market are now expanding instead of it just being 5, 6, 7 different stocks at the top of the S&P. Brad mentioned some of the economic data that was out there. I wanted to touch on that. Unemployment is still historically low. It's at 3.6%, and it's actually the lowest that it's ever been since 1970 when it was at 3.4%. And Brad mentioned, 18 months ago, basically the beginning of 22, our interest rates were in essence zero. And now we're at 5.5, headed towards 6. And he's exactly right. The markets don't operate the same whenever your cost of capital has increased that much. So there's going to be a lot of changes that happen in the last half of this year as the market and the economy try to figure out how to position itself for next year's election. There'll be a lot of volatility that happens between now and then. And Hunter, Brad, and I are planning on trying to keep everyone updated on what we see happening. Until next month, thank you guys very much, and look forward to talking to you then.